All right, to finish chapter 2, we're going to jump into a few last slides. We've got stock price and other data. This is obviously something that most people have heard of and you'll see on a daily basis looking at any financial data for companies or corporations. So you got your stock price. You can see that the company that we've been discussing had obviously a downgrade in their stock price year over year given their performance. Their number of shares stayed the same because they didn't release any additional shares or sell any. Their earnings per share obviously went down since they did not earn any money in 2016. All right, and there we go. And then we've got our dividend per share as the last metric here. And with their lackluster performance, they obviously took their dividend down. So as we talked about earlier, investors are looking for long-term sales growth, but also profit growth, which leads to stock price growth, earnings per share growth, and also dividends per share. So something else you'll see is the market value added. So that's going to be the market value of the firm minus the book value of the firm. You also see market value, or the number of shares of stock times the price per stock plus the value of their debt. You also have book value, which is their total common equity and the value of their debt. So let's look at corporate taxes and then individual taxes, because they are definitely a little bit different. So here is from 2007 to 2015 the standard corporate tax rates, and you'll see they grow in each bracket up to a certain point there around the 335,000 range, and then they go back down, and we'll talk a little bit about that. So it's called a progressive tax rate up to 18.3 million of taxable income. Below that, the marginal rate is not equal to the average rate, and then above that, the marginal rate and the average rate are about 35%. So how does this work? So a corporation can also deduct their interest expenses, but not their dividend payments. They can carry back losses for 2 years or carry forward losses for 20 years. And we saw that in that example earlier when they had a tax refund based on a loss over 2 years. They can exclude 70% of their dividend income if they own less than 20% of a company's stock. So just for those that are not familiar, a company can own its own stock, and they do quite regularly. But this is one of those rules from excluding the dividend payments. So let's assume a corporation has 100,000 of taxable income from operations, 5,000 of interest income, and 10,000 of dividend income. What does their tax liability look like? So first off, we've got 1,000 in operating income, 5,000. The taxable dividend income is 3,000, and we can see that down here below, right? Because they can deduct 70% or 7,000 out of the 10,000, which gives us that 3,000. So their new taxable income is 108. So we simply take the 108. We're going to take the tax on the base, right? Or the first 100,000. That's going to give us 22,250. And then we're going to jump up to that 39% rate on what's left over. So their total tax liability is 25,370. So that should make sense. Now, when we think about individual tax rates, we're all pretty familiar with this. Those of us who have been in the workforce for any amount of time. So individuals face a progressive tax rate from 10% to 39%. The rate on long-term capital gains is 15%, but these are only taxed when you sell an asset. Dividends are also taxed at the same rate as capital gains. So if you personally receive a dividend, it's going to be taxed like you sold a piece of property or something like that. So interest on municipal bonds is not subject to federal taxation. Okay, so state and local government bonds, they are not taxed, which is great. So state and local government bonds are generally exempt from federal taxes. We just said that on the last page. Sorry about that. So let's look at purchasing an ExxonMobil bond at 10% versus a California municipal bond at 7%. In this example, the current tax rate is 25%. Our after-tax interest income for ExxonMobil is going to be the 10% times 5,000 minus the tax rate. So we're going to end up with $375. The same investment with a California municipal bond at 7% interest is going to get us $350. So the higher the higher interest percentage on the ExxonMobil bond compensates for the tax. So we still would be better off going with ExxonMobil in this example. All right. So at what time would we say, hey, it doesn't matter what rate I'm given between the two bonds? What tax rate is that break-even tax rate? And it's going to be 30% in this example. So I'm not going to walk through all those. You guys can read that. It's a pretty simple equation to figure out where your break-even rate is. So in the implications of this, if the tax rate is greater than 30%, you buy the tax-exempt municipality bond. If the tax rate's less than 30%, then you buy the corporate bond. Only high income and hence high tax bracket individuals should buy the municipal in this situation. So there we go for Chapter 2. I hope that was helpful. Please let me know if you have any questions as you go through the material. I'll be glad to help you in any way via email, or we can set up a video chat. So I hope you have a blessed week. Thanks so much.